Welcome to our training today. Today, we're going to talk about alternative small business loans. We're going to talk about like 12 different options for you to get credit lines and loans for your business. Even when you think you can't qualify, even if you have bad credit, even if you're a startup, even if you don't have certain types of collateral, we're still going to talk about options that can work for you today. So we will be going in and, okay, let me actually, all right. So today, we're going to be talking about a lot of different cool ways to get money, how to get it quickly, how to get it easily, and how to get it outside of the big banks. Look, a lot of the reason that you might not be able to get the money you need is because you're trying to qualify for very tough to qualify for loans. I'm going to show you the easy ones so you're able to get all the money that you need for 2021 and beyond. So let's talk about alternative small business lending. So if we think about this, SBA is the main way that big conventional banks are able to offer you money. And this happens because the big banks are basically issuing you loans that are guaranteed by SBA. So what that means is it means that the bank gives you the money and SBA guarantees that if you ever default on the loan, then SBA will pay like up to 90% of whatever's due to be paid. So here's the problem. The problem with that is, and Minister, thanks for tuning in from LinkedIn, and Bismarck Sanchez, thanks for coming in from Facebook. So the problem is these are very tough to qualify. You have to have really good personal credit, established business credit, money in the bank. You've got to have collateral equal to what you're borrowing. And you also need to have cash flow verifiable per tax returns that show profits increasing every year. I mean, there's a lot, and I'm just getting started. Business plans, resumes, there's so much stuff involved. But when we talk about alternative business lending, what we're talking about is alternatives to this. You know, it used to be SBA loans were the way to go. And after the 2008 mortgage crisis, what we saw was all these alternative lenders coming into the space. Some of them are private individuals, some of them are lending institutions, but both of them have one thing in common: way easier to get this kind of money than what you're ever going to find with a big bank. So that's really what we're talking about when we talk about alternative business lendings. So for businesses that can't meet those tough lending requirements, well, alternative business lending is definitely the better way to go. The application process is fast. The funding process is fast. Your chances of approval are tens of percentages higher, 30, 40, 50, 60% higher than the big banks as well. And it's just easier and faster to access the actual money that you need. Okay. So again, the big key here is to know that banks aren't the place to go. I mean, don't get me wrong. You should absolutely go to a bank. If you have really good personal credit, business credit, tax returns for years to show profits, have collateral, go to your bank. People come to me and ask me where to go. I said, if you meet that requirement, go to your bank first. If they can't help, then come to me and I'll help. But that's always where you should go if you meet those requirements. But if you don't, well, you're in the right place, because we're going to talk about a lot of options that will work for you. So first of all, let's talk about private investors. We're going to talk about several different ways private investors can get you money today, probably a handful of different ways. But private investors are private individuals that want to lend money. So there's two ways we have to look at getting you money. First is lending institutions, alternative lenders. These are oftentimes nowadays called fintech lenders. They're basically online lenders. A lot of them do their business online, right? So they don't have brick and mortar locations like Bank of America that cost stupid amounts of money to maintain. Their business, their retail store is their website. There's a lot of fintech alternative lenders. Then we've got also private investors. Private investors are individuals that just want to get a rate of return on their money. As a matter of fact, I mean, I know we all wish we had this problem, but I just had dinner last night with a very good friend, and he said, "Man, I got a problem." He said, "Our business is killing it to a point where we have all of this money. I need to spend it to avoid tax consequences. Where do I put the money?" And so a lot of people have that problem where they have this money they want to lend. They don't want to pay the IRS taxes on all this money they have. They want to invest at certain places where they can get a rate of return. And so private investors are another way to go, where they're investing into actually your business. They get a 7, 8, 6, 9, 10% return on their money. They get more of a return they get in the stock market or real estate. And again, it's just a newer way to invest that we're seeing a lot of private individuals do. So when we talk about private lenders, we're really talking about, again, those fintech type lenders, those individual banks that are not Bank of America, Chase, the big conventional banks. And when we talk about private investors during today, then what we're talking about is actual individuals just like you and I that want to lend money. As a matter of fact, I'm going to talk about ways you can lend money to small businesses if you want to be on the other side of that. So peer-to-peer lending is a perfect example of this. Peer-to-peer lending is the newest, most popular type of funding that's come about in the last 3 years. And this is how it works. If you go and invest into stocks or the stock market or 401k, you're basically taking your own money and you're investing it into other businesses. Okay. That's what happens. You're investing into other businesses. Well, what peer-to-peer lending is peer-to-peer lending is basically a way that you could take your money and you can invest it into other businesses that are privately owned. They're not publicly owned. They're not the big publicly owned companies. They're privately owned companies, just like you and I's. So there's two ways this can work. You can invest into other businesses that are owned just by, private individuals like me, or you can get these platforms, these people that have money on these platforms to invest money into your business. So with peer-to-peer lending, the most common sources out there are Lending Club and Prosper. Prosper was the first one out there. Lending Club's like 42% of the peer-to-peer lending market. There's also Upstart, $35,000 loans for startup businesses. And we're going to see what happens with the military side of things, because Street Shares was always the military provider in this space, and they kind of stopped lending during COVID. So we'll see what happens. So with peer-to-peer lending, we basically take backers, people with money, people that are private individuals, non-accredited investors that want to invest into businesses like your guys. And then they have borrowers, people like you and I, and the platform Lending Club combines the two. They come in, they get your application. They say, okay, what kind of money do you want? And they do a credit check, and they have their own proprietary algorithm that they look at to determine your risk. And once they figure that out, then they say, okay, we can get you $25,000. Now what they do is they go to, take the money from 30 different investors, 1,000 here, 5,000 there, $500. They comb it all together, and then they give you that $25,000 loan. Then all those backers, those individuals out there that put in that money, well, those guys get a rate of return. They get a percentage of, whatever you pay back, the interest that's earned. That's how they make their money. So again, very good, reliable place for a company or for private individuals to invest their money. And this is what we're seeing happen. Now, the reason this has become so popular is because they accept what's called non-accredited investors. And when we talk about investors, private investors, we have to talk about both sides. Accredited investors have to meet certain requirements. I think the requirements are like, I think 250 or 500,000 in annual revenue and like $1 million net worth. If you don't meet that, you can't be an accredited investor. But peer-to-peer lending lets non-accredited investors, people like you and I, that might not have $1 million net worth, whatever it may be, get in and start lending. So peer-to-peer lending has really opened up the door for people that are non-accredited to start putting money in and be able to invest into the businesses. And it's definitely a really good way to go, because with peer-to-peer lending, you don't have to have good credit. You don't have to have tax returns. With an average 620 type of credit score, you can get approved. Upstart likes young professionals, college graduates. So if you're a young professional, startup, college graduate, good chance you can get approved if your credit's even average. Lending Club, those kind of guys, if you have average credit, 620, 650, and the deal makes sense based on your income, how much you're looking for, then they'll typically give you money as well. So a really good source to look into. Lines of credit. Now, lines of credit are available from a lot of alternative SBA lenders, a lot of them. So there's a lot of alternative private investors that typically lend 5 to 8%, sometimes higher, 10% interest. And they'll lend you money. They look at 1-year tax returns, and they want you to have average credit. And this is what these guys look for. They look for tax returns that show some kind of profit. So that's preferably what they're really looking for, is a tax return that shows some kind of profit. Then they're also looking to see that you have average credit, 620, 650 credit score or higher. So this is why I tell a lot of people at the end of the year, you need to file your taxes and show some kind of profit. Because in my world, the business lending world, the difference between you showing some kind of profit and some kind of loss is a significant difference with these guys, with alternative lenders that will give you lines of credit and loans. If you want longer term, low interest rate lines of credit loans, you need to have tax returns to show some kind of profit. If you don't show some kind of profit on your tax returns, you're just not going to be open to this kind of money from alternative investors. But if you do, 620 type credit score, you could typically get involved. There's a lot of private investors out there that'll do this. Now, do me a favor. If you're getting value from this, just hit the like button, hit the love button, please. That helps me get other people in here and show it. The only way the social channels actually come in and show it to more people is if you're engaging. So if you don't mind, hit the like button, hit the love button, hit the share button. If you're getting value from this, is all I ever ask. Okay. Now, merchant cash advances. These are available through a lot of fintech lenders. Not really through private individuals. They're more lenders. And what merchant cash advances are is they basically will take a look at your credit card transactions, and they'll lend you as much as, let's say on average, about 12% of whatever your annual revenue is as verifiable per those merchant statements. So if I'm accepting $200,000 a year with Visa and MasterCard payments for my customers, then I can get up to 12% of that lent to me, which is in that case example is like $24,000. So you can get about 12% of whatever your annual revenue is lent to you with this kind of money. And the requirements are pretty easy. It's 6 months time in business and $5,000 a month in revenue. If you meet that criteria, you can get approved. Notice I didn't say a credit score requirement because a lot of lenders go as low as 500 FICO here. A lot of lenders don't care. They'll lend you money regardless of how bad your FICO may be. The premise between merchant cash advances is that if you are consistently getting revenue in your business, and if that revenue is steady or even slightly increasing, then the expectation is that you'll continue to get more revenue. And the result is the lender will give you money based on that future revenue. They're kind of basically buying a portion of your future revenue back at a discounted rate is actually how it works. So I like MCAs, super fast money usually in 72 hours or less, way easier to get than any kind of bank loan. You don't need collateral. You don't need good credit. You don't need tax returns. You just need consistent credit card deposits. If you got consistent credit card deposits in your bank account, and you're managing your bank account responsibly, chances are you are good, you can get approved. Let's talk right now as we get further into this, what meaning managing your bank account responsibly is. There's like 3, 4, 5 things they basically mainly look for. I'll count them as we go. Positive ending bank balance. You have money. Your statements show that you have money in the bank at the end of each month. Very few non-sufficient funds. The more non-sufficient funds or overdrafts you have, the less likely it is you get approved. It's why you should always have 2 bank accounts linked together. If you overdraw your checking account, the money should come from your savings. It avoids non-sufficient funds. They want you to have a bunch of consistent deposits. They don't want a real estate agent that has 1 or 2 transactions in a month. They want a bunch of consistent transactions. And the fourth thing, now we know there are 4. The fourth thing is that they want there to be, they also want there to be regular deposits, which I just mentioned, the consistent deposits. And the fourth thing, which escapes me right now in this moment, is more money going in the bank account than going out. Positive cash flow. They want more money to be deposited than what's being withdrawn. If you meet those 4 requirements, chances are very good that you can qualify for merchant cash advances. Now, merchant cash advances also care about chargebacks. If you have a bunch of chargebacks, that's problematic with these. But if you meet that criteria, chances are very good that you should be able to get approved. And Salsan says, hi, thanks for coming in. Teresa, hello from YouTube. And Constance, hello from Facebook. Thanks for coming in. So let's talk about rewards-based crowdfunding. Rewards-based crowdfunding is Kickstarter, Indiegogo. These are, again, similar like I explained with peer-to-peer lending. They take backers, people that just, want to give money, want to buy a product, want to invest into something like this. And they combine it with people that actually have a need, a project that needs to be funded. So these typically work best if you have a unique product. If you are a real estate investor, you're not going to probably do real well on crowdfunding sites. There are other places you can get money, but not here. But if you create some kind of really cool gadget of some sort, something the world has not seen, something people would get excited behind, the kind of stuff we see on Shark Tank, those are really good projects to deploy on crowdfunding because they can gain virtual traction They can go viral and gain viral traction because they're fun. They're cool. The people share them. People talk about them. So to work on crowdfunding, you really have to have something that's unique, something that's different, something that's going to get people talking. And if you have that kind of invention, that kind of product, then this is a good place to go. You have to be careful. There's fixed and flexed funding. Fixed funding means and this is very common with Kickstarter. If I tell Kickstarter I'm trying to raise $30,000 and I only raise $27,000, with fixed funding, they won't give me any of my money. I get none if I don't meet the financial goal I set. With flex funding, like through Indiegogo, if I'm trying to raise 30 grand, I only raise 27, they'll give me the full 27. So you need to be very aware of fixed versus flex funding. You need to do some research into the crowdfunding platform that you want to look into. Some are better for certain industries than others. And you have to know that these are based on 2 things to make them succeed. 1, your ability to line up backers before the project goes live. If you want Indiegogo to start showing it to everybody, then you need to put that project live and start driving all of your own backers there that start giving money. Then Indiegogo sees that a lot of people are getting the website and giving you money, then they'll show it to more people. Secondly, and most important, it's based on your social network. You need to have a killer networking strategy to get your project out in the world to be seen. You can't rely on the platforms like Indiegogo to make it viral. You have to make it viral by sharing it to your social network. They share, etc. That's exactly why you have to have a unique project, because this thing is really based on virality to raise the money you need to raise. And you're not going to get virality if you don't have something really unique that gets people talking. But if you do, crowdfunding, rewards-based crowdfunding is a great place to go. Now, Equity crowdfunding is something fairly new. Okay. And equity crowdfunding equity crowdfunding actually comes in where now they've kind of found a way for even non-accredited investors and especially accredited investors to basically crowdfund money to be able to invest in businesses for a stake, for an ownership interest. So with equity crowdfunding, you're going to give away some kind of interest in the actual business. Okay. That you are going to be selling equity for their investment. The good thing about equity crowdfunding is that, unlike debt financing that has to be paid back on certain terms, you don't have that with equity crowdfunding. And you set the terms. You set how much stock you want to sell. You set how much you want to sell the stock for. So your control of how much of your business you're actually selling to get the money that you need. Always remember, there's two ways to get money for a business. There's equity and debt. You can either sell the equity, sell some stock and get money that way, or you could take on debt in the form of a loan or a credit line. There's always two ways. It's equity or debt. This is equity. You're selling equity. The benefit of equity, again, is that you don't have to pay a monthly payment. So if I'm a startup business, I could raise money through equity crowdfunding and get the money I need to create the product, get the product off the ground, figure out how to sell it and market it and make revenue and generate profits without needing to pay a payment back. With debt financing, I have a payment to be made right away. So kind of I'm under the gun to start making money because I got to pay back that debt. So difference between the two with equity and when it comes to debt financing. So equity crowdfunding, you want to look into a couple different places. Crowdfunder is the most popular. You can leverage their network for $299 a month, or your own network, and use their platform to raise the money. Or you could use their network and have them help you raise the money for $499 a month. There's several of these companies out there, but crowdfunder.com is one of my favorites that I think works really well. Bridge loans, these come in all sorts. Bridge loans bridge the gap between the money you need now and the terms you want to get, right? So let's say you can't get an SBA loan. Well, a lot of these options can work as theoretical bridge loans. So I'll give you an example. We've got a program called Credit Line Hybrid I'll introduce you to later today. $150,000 in credit line, 0% rates. Well, you have to have utilization below 40% on your consumer credit report, which means your balances on your credit cards need to be 40% or less of your limits. So what if you're not? What if you're 45 or 50%? Well, there's a bridge loan that will pay down your existing credit cards to get your utilization lower. Then you qualify for Credit Line Hybrid. You get your credit lines and pay back the bridge loan. That's a perfect example of how bridge loans work. They bridge the gap to get you what you need to qualify for the real kind of loan you're qualifying for. Very popular with real estate transactions, residential and commercial. Very popular, like I said, with Credit Line Hybrid. And there's a lot of other options we talked about. Anything that kind of bridges the gap can qualify, but there's specific kind of bridge financing, like I mentioned, for Credit Line Hybrid that really bridges that gap. Now, hard money lending is when you could just basically work with private investors that charge pretty hefty interest rates, but they'll do stuff you're typically not going to get done. So a friend of mine called. He owns zoos around the country. He's one of the most interesting guys I've ever met in my entire life. He has like a treehouse village down in the Dominican Republic and resorts down there and resorts everywhere. And he actually had some homes he owned, and he didn't owe any money on them. And he didn't want to get a mortgage. He had some issues qualifying for the mortgage, but he wanted to use those homes as collateral to be able to get money. And I said, yeah, that's possible. We've got a hard money lender that will do that. The rate's not generous, but here's the rate. So that's a perfect example of somebody that has an asset. He had an asset. He has a house. He wants to leverage to get money. He can't qualify for a mortgage. Well, then a private investor comes in and goes, yeah, that deal makes sense. Like if you default, I take the house, so I don't lose anything. And they charge him a little bit higher interest and they give him that loan. So that's an example, but there's a lot of different kind of hard money loans you can get. Almost any kind of financing that you're looking at out there, there's a version of a hard money lender that will do it with high interest or higher interest terms from private individuals or lenders. So let me give you another example. I told you about merchant cash advances. We'll talk about cash flow financing as well. So merchant cash advances, for example, they'll give you a first position loan. Bam, here's your loan, here's your line of credit. Well, there are hard money lenders that will give you a second or third position loan, which means they'll give you a loan after the first place. Already gave you a loan because they know if you qualify for the first place, you're good enough risk for them to lend you money. So all they do is Focus on people that already get a first position loan and come right behind them and offer them another additional second position loan at higher interest for people that want more money, which is typically everybody. Everybody wants more money than they could typically qualify for. So that's a perfect example of hard money. There's a lot of examples of hard money, but these are private individuals that will charge way higher interest rate for deals in their niche that make sense, but that you typically can't get other kind of financing for. Hello, Kenneth. Thanks for coming in on Facebook. And Sade, thanks for coming in on YouTube as well. I appreciate it. So again, hard money lenders is definitely a very good way to go. Less stringent underwriting requirements, usually fast and easy money. Federal grants available from HUD, available from USDA. There's also something I think called grantwatch.com for local and state grants you can look into. I know it's not loans, but I always recommend grants because most people don't apply for these. So there's a lot of free money out there. The same with state and local grants. Grantwatch.com has a lot of those as well. You should always check into this because it's free money. It takes some time. You have to fill out an application, but the more niche you get in your community and your state, the easier it is to get approved. Guys, I mean, very rarely do I talk to a business owner that has ever went out and got a grant. Very rarely. And so it tells me that not a lot of people are out there applying for these, and it's something you really need to consider. So when we talk about angel investing, we're talking about private individuals giving you money instead of private institutions. And we talked about both in the beginning of this training. So angel investing, there's two different kinds of angels that are out there. They're what are called affiliated angels. These are people you know, your dad, your mom, your friend, people around you in your circle that will give you money. And there's unaffiliated angels, what you and I think about when we think about angel investors, people we don't know, that we could solicit with a pitch deck, pitch them, and then they'll give us the money that we need. Now, I have training on our YouTube channel, youtube.com/credit suite, on how to put together a pitch deck. So I actually walk you through what you need to know to be able to put a pitch deck together for angel investors. And there are formal and informal investors, and it really has to do with whether they're accredited or non-accredited, basically. We've already talked about accredited versus non-accredited. There's a reason I went through all of these things in the beginning, because now you can actually put the two together and actually see what the difference between accredited and non-accredited is. So formal investors, informal, there's both. There's people that are accredited. There's people that aren't accredited. That being said, angel investors are on the startup stage of a business, usually before you have a product and almost always before you generate revenue and profit. That's when these guys come in. So if you're in a startup and you have something that's different, that you are creating a new sector per se, or industry, or you're the top in your sector, or you dominate a certain niche in your sector, these guys love that, okay? They will love to put money into something where they get really high returns, but the risk is still high as well. So if you're in a high risk situation, they're very good. Now, venture capital is the next stage. Venture capital, angel investing, they want you to have an exit plan to get out in 3 to 5 years. Venture capital usually gets involved after you're already selling a product, possibly before you're generating profits. So you're generating revenue usually before these guys come in, and you are typically don't have to be generating profits for venture capital. If you want to attract a bunch of venture capitalists, I mean, get these guys to beat down your door, what you need to do is you need to go and find a list of Inc. contest, entrepreneur contest. Yeah, you know, all these magazines like Inc., Entrepreneur, Forbes, they all have competitions, right? So Fortune has the Fortune 500. Inc. has the Inc. 5,000, right? What I found is that if you get on one of those lists, Entrepreneur had an Entrepreneur 365, the most entrepreneurial companies in the country. Okay, we were awarded that in 2018. When you get on these lists, these guys beat down your doors. And it's not as hard as you may think to get on these lists. A lot of people just never apply. So look at that. My advice is get a list builder like we have to go do a list of all the Fortune 500, the Inc. 5000 type of competitions out there, best places to work, blah, blah, blah. And then apply for any of those you think are relative that you think you might be able to get approved for or get actually accepted for. Because once you hit those lists, these guys will beat down your door. They call you. I get 2 to 5 solicitations every week from venture capitalists or people that want to buy my business just because they're getting my name from the Inc. 5000 list. That showed me the shortcut there to get these guys lined up. But you can also hunt them down individually as well. But venture capital, you're usually looking for money in the millions. They want more ownership interest. They want more control. They want to sit on your board of directors. They want to pull the puppet strings. But the good news is, man, these guys could offer a tremendous amount of benefit to you as well. One of my friends is one of the biggest in the credit card stacking space, where they get credit cards, stack them together, and get you a bunch of money by putting together a bunch of business credit cards. And he had one of his guys. He had one major guy that came in with venture capital that used to be in the credit bureau space. And man, this guy has been a heck of a partner for him. Helped get him approved to get credit reports with soft pulls, helped get him the ability to report their payments to the business credit reporting agencies, all kinds of benefits because they partnered with somebody that was in a similar industry. So venture capitalists, they will want a seat on your board. They will want more control, but they are so valuable to you if you get the right one. They can help you grow way faster because they have the connections and knowledge that you don't yet have. So a lot of benefits here with venture capital for sure. And Stephanie, hello. I appreciate you coming in. Happy holidays, Watch Out Media. Thanks for tuning in. I appreciate you being here every week. The same as Bismarck Sanchez. I appreciate you as well. So business revenue financing. It's called royalty-based financing, a lot of different things. Look, this is exactly like merchant cash advances. But the difference is for this, you typically need to be in business 1 year and have one or 10,000 a month in revenue versus merchant cash advance, which is 6 months, time in business 5,000 a month in revenue. And with business revenue lending, they're going to look at all money that was deposited in your bank account, not just credit card transactions. They're going to look at cash. They're going to look at checks. They're going to lend you 10, 12% of all the money coming in through that business bank account, not just credit card transactions. Still really fast way to get money, 72 hours or less. Credit scores don't matter. Collateral doesn't matter. All that matters is that you have consistent cash flow or increasing cash flow and that you meet those 4 requirements I talked about earlier in this training for how you manage your bank account. Inventory financing. So there's a couple different kinds of this. One of mine is, it's one of my newest favorite funding options for 2020. Inventory financing typically helps you buy inventory to put on the shelves or borrow against inventory you already have. You can get a credit line for as much as 50% of the value of the inventory, a 5% interest rate or higher, 3% closing rate, or three-week closing or sooner. But my favorite new one is through a company called Kick Further. And you can go to creditsuite.com/inventory, find a quick link to Kick Further. If you have $150,000 in sales online, like through an Amazon business, Kick Further will actually crowdfund the inventory you need. So let's say I'm selling like widgets I'm selling water on Amazon, right? That's a bad example. Let's say I'm selling these little books here from my buddy Dave Wyman. This guy's brilliant. Selling these little books here on Amazon. I sell 150,000 of these things. Well, then what they will do is Kick Further will give me the money to buy all of the rest of these I need in the future. They'll give me the money to buy the inventory. Then as I sell these things, I pay them back. So they give me the money I need to buy my inventory. Then as I sell my inventory, then I pay them back. So it's a great way to go because if you have some experience selling online, Kick Further will fund all your inventory for you. You don't even have to come up with this. So 2 different ways you can use inventory financing on the alternative lending space. 401ks and IRAs. If you have a 401k IRA, you know somebody that does, you could tap into that, borrow as much as 100% of the 401k or IRA, get a 5% interest credit line or loan, and close in a pretty short period of time. There's no tax penalties. It's basically a rollover where instead of investing your money into other people's businesses, which is what a 401k is, you're investing the money into your own business. You're rolling it over and investing it into your own company. One of the most popular kinds of financing for partners that come in to start a business together. Remember, if you don't have a 401k or IRA, you could still tap into somebody else that you may know, family member, friend, investor. Securities-based financing, same thing. Interest as low as 1.6%, typically less than 5%. You're using stocks and bonds to qualify, get financing up to 90% of the value of the stocks and bonds, and you still earn interest on the stocks and bonds. I love this. Love it, love it. And I'll tell you why. You're double dipping if you think about it. You've got money invested in the stock market that's earning a return for you. Then you use that's already leveraged. You leverage it and get a credit line that you can then use to blow up a business. So it's kind of like double dipping because you got it in money invested that you're earning interest on. And then you've got this other money. You're going to use it as collateral to get a credit line to build a business that you're then getting a return on. I love it. The way I saw it like this is that 75% of business owners get money from family and friends. But if I go to my dad right now, and I use this example all the time, so if you've heard me say this before, it's just the best example I have. If I go to my dad and say, Dad, I'm trying to get a business off the ground, then my dad, and I say, I need 50 grand to do it. If I asked my dad for 50 grand, he doesn't have 50 grand in his bank account. He would go sell stocks to get me the 50. Okay. Now he sold stocks. He's not earning interest to give me 50,000 in cash. I could go to my dad and say, Dad, I need 50,000 to get a business off the ground. Here's the great news. You don't need to sell anything. Give me any cash. I just want to leverage one of your stocks to be able to get a credit line against for 50 grand. And the only way you'd lose is if I default, then they take 50,000 of that stock. But if I make my payments and we can set up something where I pay through you, so you know the payment's getting paid, whatever it may be, then you still earn interest on the money. And I actually can get the $50,000 credit line I want with the low interest. So it just gives you the ability to borrow borrow from people around you easier with this kind of financing. So whether you have stocks and bonds or not, you really want to consider this, because again, even if you don't, there's a good chance people around you do, and they might want to earn a rate of return. Guys, look, my friends know I'm good at what I do. I'm a good entrepreneur. Okay. And I don't say that to brag. I'm being humble. Look, I read 100 books a year. I mean, I'm obsessed with learning and getting better. Okay. And I'm a very humble person. I'll learn from everybody. I have so much to learn. Even people new in business, I want to learn from everybody that will teach me anything. So my friends, if I'm getting a business off the ground and I need money, I promise you, I have a lot of people around me that would want to put money in and get a rate of return. They would love to earn a rate of return on my brain and what my brain is going to go produce income-wise. A lot of people around you are the same way. They want to invest money into you and what you're doing because they know you can kill it, and they want to earn a rate of return on that. So this is a way that you could leverage their asset, get the money you need, and they could get a rate of return and earn interest on that, or earn ownership interest of the business. You can sell them, et cetera, et cetera. Again, if you're getting value from this, hit that like and love button and share it if you're really getting value. I appreciate that. And Mark says, just signed up today. Oh, congratulations, Mark. Thanks and welcome to our family, man. I'm really glad to have an opportunity to work with you. And Johnny says, is it like Fund to Grow? That's not. But I will show you Fund to Grow. Fund to Grow has a program similar to Credit Line Hybrid. I'll introduce that to you in just a minute. Purchase order financing, pretty simple. You can get 95% of the money you need to fulfill purchase orders. If you don't have a product that you need to fulfill purchase orders, this isn't for you. And if you do, then it is. Okay. And what I mean by that is that if you need to go in a perfect example of purchase order financing is that you're a t-shirt embroidering company. You get a huge order for shirts. You got to buy the shirts before you embroider them. You don't want to spend all your available cash to buy the shirts, then embroider them, then wait to get paid. With PO financing, you can get 95% of the money you need to buy the shirts, get them, embroider them, sell them, then pay back the PO financing. So it gets you the money you need to fulfill purchase orders without coming out of your pocket with that money. That's how this works. Okay. Now, account receivable financing, AR financing is, I'll give you a perfect example. Good friend of mine does the plastic mugs for Busch Gardens, you know, the ones you spend like $10 for with a drink and they're all fancy and say Busch Gardens on them. So he gets a major order from Busch Gardens, let's say 10,000 mugs. He's got to order all the plastic for those, right? Then he's got to use his machines, use his labor, produce the mugs, put the logos on them, ship them to Busch Gardens. And then Busch Gardens probably doesn't pay for 30, 60, 90 days. He probably gives them 30, 60, 90 days to pay. So from the minute he gets the order to the minute he gets paid could be 3 months. And he's out a lot of money in labor cost, electricity, running the facility, buying the stuff. So AR financing bridges that gap. It's a way that the lender will come in and lend as much as 90% of that AR and get it to him within 24 hours. So he gets a huge order from Busch Gardens for 10,000 mugs. And the next day, the lender gives him 90% of that money. Even though he hasn't even produced them yet, the lender gives him 90% of the money. Then he has all the money he needs to produce the mugs, go get the bugs to Busch Gardens, and then once they get paid, then the lender gives them the rest of the 10% minus their fee. So what's nice about AR financing is it allows you and I the ability to make it really affordable for our customers to pay us. We can let our customers pay us on terms in time, and then we still get up to 90% of our money right away. So like we can't lose there. And it's as low as like 1.25% factor rate. So it's really affordable, cheaper than accepting a credit card, and a way that you can make it easy for your customers to pay you, and also make it easier for you to get that money very quickly. Okay. And Teresa says, it used to be kind advice sharing what I've learned, but when my time is spent helping someone learn to fix their credit, can I charge for my time? They benefit, and I'm glad, but how do I do it? How do I do it? Well, that's definitely not a question right now for this training, but I'll tell you this much. What I found is this. I get what you're saying is that, look, I don't want to just give away information. I want to charge for that. And you can. There's nothing wrong with that. I'm a different kind of person. What I found in my life is that if I just give without expecting anything back in return, a lot of opportunities present themselves that you're not really aware of. And I'm the kind of guy where I kind of give freely and then figure out how to kind of monetize and make money on it later. I know that doesn't help you, but again, what you're doing is a good strategy, but you really want to consider getting out there and helping other people without charging, giving the people you're talking to in your tribe a free way to get information and then a paid way to work with you. And I think if you do that, Teresa, you'll find that a lot of people are willing to pay and work for you because you openly give from your heart with no expectation of getting anything in return. That's just a little bit of advice. I know it's off topic, everybody, but I wanted to make sure I answered Teresa's question. So equipment financing and leasing, it lets you buy equipment, lets you lease equipment. So for example, one of my friends was opening up a doctor's practice, needed a big piece of equipment, came to us to get a credit line to buy it. I said, you don't need a credit line, you need equipment financing. Let's get you a credit line and equipment financing. Got equipment financing. She needed the first and last month's payment down, 2 months payment as down payment, used the credit line to pay the 2 months down payment. She got equipment financing for the equipment, credit line to pay the first month, 2 months payment. And she had a whole credit line available for other reasons she could use because she used specific financing, equipment financing to get equipment. Now, you can get equipment financing as a startup. Average credit score, 620, 650, FICO is what they want to see. You can get equipment leasing, which is the same thing. It's just the payments are cheaper when you're 1 year in business. So get different unique ways to be able to get the equipment financing and leasing you need. We talked about cash flow financing already. Microloans are another great way to go. SBA offers these up to 50 grand. The average microloans, 13,000. A lot of different places that you can get microloans out there. Microloans are easier to qualify, 500 bucks to 50 grand usually. And you can get them as a startup. You can get them as a newer business. They're just going to want you to have average credit. A lot of places offer these. If you want more information on this, go to youtube.com/credit suite, type in microloans, and you'll find our training with a bunch of options on microloans. But I can tell you SBA has one of the best microloans that I've seen. Credit line hybrid. Somebody asked about Fund and Grow. Fund and Grow does this. This is the program that Fund and Grow offers. It's called Credit Line Hybrid is what we call it. Theirs is similar to this. It's also called credit card stacking and many other things. The way that Credit Line Hybrid works is this. Credit Line Hybrid, the funding source, will go out and get you basically a stack of credit cards. That's why they call it credit card stacking. They get you 3, 4, 5, 6, 7, 8 different credit cards. Some of these credit cards will report to the business credit reporting agency. So to help you build business credit at exactly the same time, you get 0% rates for 6 to 18 months on these credit cards. And you could take the cash out. That's why I call them credit line hybrid. You get the benefit of a credit card, 0% interest, the benefit of a credit line, okay, because you could take cash out at 0%. It's a hybrid between those two. 680 FICO score plus typically for approval. You could use a guarantor. So half of our clients that get this, their credit's bad. They're just using a guarantor, family member, friend, et cetera, to be able to use their credit to be able to qualify. And this is a great way to go, especially because you can get the money up to even as a startup. And again, you can get approved for as much as $150,000. You're able to get approved with this program with 0% rates, no cash flow verification. It's no doc. You just need to not have judgments, bankruptcies, liens on your credit report. You could typically get 5 to 8 times the amount of the highest credit limit you have now. Now, somebody mentioned Fund to Grow. They're a great source for it as well. And we work with a bunch of other good sources. So if you're interested in any of these programs or interested in Credit Line Hybrid, give us a call. We'll talk to you more about it. Depending on your industry, depending on a lot of other factors, one source in this space might be better than another. Okay, we found that some sources work really good for startups. Others work really good if you just want business cards. If you want more 0% cards, other sources work better. So if you let us know when you talk to us what you're looking to do, then we can go get you a pre-approval same day with the best source that's going to deliver that. All those lenders in that space that you guys know of or don't know of, we work with. So a lot of different choices here. You don't have to get funding from the big banks. You can get it from alternative lenders. You can get it from private individuals. Usually some of them are based on your cash flow. Some of them are based on your credit. Some of them are based on collateral, as you've seen. Business credit works if you don't have any of those 3 things. And keep in mind, if we can help you along the way, give us a ring. We don't charge you any money. It doesn't mean the lender won't. The lender's going to charge you interest and fees. We negotiate with them to get it cheaper than you get it on your own. But we never charge you a dime to consult with us and have us help guide you to the best places to be able to go. We work with over 1,000 funding sources, every legitimate funding product, and we'll help you understand what's needed to qualify for an SBA loan. And again, it's free for us to work with us. It doesn't cost you anything. I know you might say, well, how's that work? Well, some of them give us a referral fees. Some of them give us a referral commission per se, and some of them don't. It doesn't really matter to us. Funding is not, even though we funded $50 million in dollars and money last year. It's just not a big part of what we do. We're big in the business credit fundability space, but we work with over 1,000 funding sources, and we can help place you with the right source that will help you get the most money at the best terms. And if you got value from this, please hit the like button. Please hit the love button. It's all I ask. I think it's minimal ask. And make sure you give us a call, 877-600-2487. Email us info@creditsuite.com. When you give us a call, we will get your business credit reports for you for free. They're $249 from the Bureau. We'll do a fundability assessment to find all the stuff in your fundability that's messed up that will prevent you from getting loans or credit lines. We'll help you fix that. And we'll do a funding qualification, tell you all the money you can get right now. It's 100% free for that consultation, including the $250 worth of business credit reports you get. Just give us a call or send us an email, or you can schedule a consult online at creditsuite.com/consult. We've got a great guide at creditsuite.com/live that will teach you build business credit, and a great guide at creditsuite.com/27, just the number 27, that will give you 27 killer ways to get money for your business. So make sure you check out those free guides. And if you got value here, go creditsuite.com, top right of our page. At the top right of our page, you can see we have daily tips on Instagram, Twitter, a lot of our channels. So like and subscribe on those channels. If you subscribe on YouTube, click the bell beside subscribe, select all so you get notified when we go live. And then also make sure that you check out our podcast, the Business Credit Financing Show. Nearly 400,000 downloads. We interview a lot of experts in their industries that help you start a business, grow a business, market a business. I talk about money a lot. But on our podcast is the only place I interview experts in all these other industries to teach you all kind of growth hacks that'll help you grow your business faster as well. So so consider following us there. And really bad advice as well. Listening to this guy is a really good idea. I love your name, Really Bad Advice. That's fantastic. Really Bad Advice now says wouldn't trust this guy. So now everybody says you shouldn't trust me. Really Bad Advice doesn't think I'm trustworthy, even though he just met me. And there's no reason for that explanation. It's what we call a troll on social media. And Watch Out Media says, when opening a business checking account for LLC, do we really get automatically offered a business credit card as well? No, you don't. As a matter of fact, that's a great question though, Watch Out Media. I've found that the one thing that really triggers business credit card offers is a business credit profile and score. Once you start to build a business credit profile and score, that is exactly when you'll actually start to get a lot of credit card offers. Okay. But opening a checking account really isn't going to give you a lot of offers. Just the fact that you have a checking account will trigger a lot of people to know you're a business owner. But usually credit card offers are based on certain things like credit scores, et cetera, et cetera. In the business world, it happens by building business credit. And Kenneth says, man, you're the best. So hopefully this helps you all. Oh, and Tariq says, looking for money. I'm a current partner with Credit Suite. Give us a call. If you go to contact us at the top right of your portal, you can contact our funding team, our advising team. They will help you get access to exactly what you need. So I thank you all for tuning in. And I look forward to seeing you on our next training where we talk about more cool ways to get money to start and grow your business. Thanks, everybody. Have a great day.